Hi, and welcome to video 6 in our options series. At the end of video 5, I was talking about exercise and assignment as they relate to call options. Now I want to talk about exercise and assignment as these concepts relate to put options. So again, exercise and assignment. Well, just think about it logically. When you own a put, you have the right to sell 100 shares of the underlying stock at the option strike price on or before the option's expiration date. And so if you hold the put through the moment of expiration, remember you can no longer sell it. The option's expired. But if the option is in the money, and for a put, in the money means that the exercise price is greater than the stock price at the moment of option expiration, okay? That again indicates that the put is in the money. It's an important phrase, in the money. The strike price of the put X is greater than the stock price at the moment of option expiration. And that means that put is going to auto exercise. So the person that owns the put is going to end up selling 100 shares of the underlying stock. If they own 100 or more shares, then they will actually sell 100 of the shares they own, and the size of their long position will decrease. If they own no shares in the underlying stock, then they will end up with a 100 share short position in the underlying stock. If they own somewhere between 0 and 100 shares, then they will end up with 0 shares and some short position with a size that's in absolute value less than minus 100 shares. Excuse me. Okay, so that's exercise. If you're long a put and you hold it through option expiration, the put will auto exercise. Well, that means someone's going to get assigned. Who? Well, one person that wrote the put will be assigned for every put that's exercised and auto exercised. My understanding is that it's a random process. The brokerage firms are chosen at random by the OCC, and then within the brokerage firm, that too may be a random process where they choose which account that has a short position on the put that has been exercised gets actually assigned. They may choose the account that has had the short put for the longest amount of time. They being the broker, and assigning who actually gets stuck with this assignment. And again, just think about it. If you're the person that owns the put has the right to sell shares. Sellers are looking for buyers. That means you, as the writer of the put, are going to have to buy. So again, if you write a put, you do that to receive income. Effectively, the amount that someone pays to buy the put is the amount that you get for writing the put. The cash flow into your account is immediate when you write the put. But when you write the put, you've taken on an obligation. Initially, you have a contingent obligation to buy 100 shares of stock if you are assigned as a consequence of being short that put. Once you're assigned, then you have to buy the shares. At what price? At the strike price, X. You have to pay X, the contractual price, the strike price of the option, for those shares. And notice the price you're paying is higher than the stock price at that moment in time. There will be after hours trading, and you would be able to sell the shares immediately in the after hours. So this price, I've indicated stock at option expiration, is likely very close to the price that you would receive if you wrote the put, were assigned, bought shares, and then chose to dump them. That's very close to the price you would get. And notice the price you paid is higher than the price you received if you chose to liquidate your position. Remember, the person that bought the put has the right to sell. They're selling to you. You had a contingent obligation to buy. Since you were assigned, you now have an obligation to buy. You buy, and now you own 100 shares of the underlying, and then you'll sell them at this price if you choose. You may hold them if you desire, but you'll lose money there. Now, you can still make money on this. You're going to lose money as a consequence of buying the shares at the strike price and then selling them at the stock price. But you may have received more when you wrote the put than the amount that you lose here. So it's possible you'll still make money. We'll go over that stuff in more detail as we go through this series on options, pricing, valuation, and trading strategies. Alrighty, so that's exercise and assignment as they relate to puts. So now we'll turn our attention to another topic. And this topic will be profit diagrams. Before I've shown you value diagrams, just to remind you, this will be call value as a function of stock price at option expiration, and this will be put value as a function of stock price at option expiration. So if this is stock price at option expiration, of course, it's put value at option expiration, and the same holds for call value. So here is, if this is the strike price, this is call value. If this is the strike price, then this represents put value. Okay, so that's just review of what we've seen before. And now I want to make a simple observation. And that observation is that profit is simply equal. Now this is profit, I'll put a subscript OE. Profit as of option expiration is simply equal to value at option expiration minus cost. Okay? Certainly nothing complex about that. Profit is simply equal to value minus cost. Profit at the option expiration moment is equal to the value of the option at option expiration minus cost. Okay? And the cost of the option is historic. It's fixed. It's history. And therefore it's known. Okay, so this is a constant. And let's just pretend that the cost of this option was $170. We'll use the call first. Let's assume the call cost us $170. Well, think about it. If you wanted to turn the call value diagram into a profit diagram, right? Well, all I have to do then is subtract this constant cost from the value of the long call at every possible stock price. So it's like we're going to take this and just push it down $170. And when we do that, we're now going to need quadrants 1 and 4. There's the strike price. And instead of having the line here, it'll be down here. Notice, very important, that the bend occurs at the strike price. Okay? And this value here will be minus 170. Okay? And this, of course, is profit as a function of stock price at option expiration. And now I'll put down here, maybe above it, long call. Okay? So long call means we own the call. We bought to open. All right, and this is the profit diagram as a function of stock price at OE. Again, we have similar, we have this identical two linear segments, one with zero slope, one with a slope of plus 100. Why is the slope plus 100? Because the multiplier for the option contract, you'll recall, is 100 shares. And so on the horizontal axis, we have stock price, which of course is per share, but the option contract is for 100 shares of stock. The call option gives you the right to buy 100 shares of stock. So that is why the slope of this line is 100, because we are effectively calculating the profit based upon a standardized exchange-traded option, in this case a call, that has a multiplier of 100. And so, that's why the slope here is plus 100 from X on up. And this is our profit diagram. Now, a very important observation can now be made. And that is that notice that if the stock price at option expiration is anywhere along this portion of the horizontal axis that I've indicated in red, that call option would be in the money at option expiration, because a call option is in the money if the stock price exceeds the strike price. Remember, the strike price, the X value on the call option, is the price that the contractual price that you have the ability to pay if you choose to exercise your option. And if the stock price is higher than that, well, that means you could exercise your option and get the shares at X and sell them at any one of these higher prices. But what we notice is that you will incur a loss, because this is zero horizontal axis on the profit vertical axis, and you will be incurring a loss at any stock price along that red line. And we know that stock prices along that red line are greater in value than X, but you will still be incurring a loss. And then we make an observation that, well, this point right here then would be a break-even point, like an accounting break-even, ignoring time value of money. And that point would be the lowest stock price possible for us to break even on our investment in this long call. And if you think about it, we have to somehow make up $170. If our call cost us $170, we have to make up $170 to break even. And what stock price at option expiration would allow us to recoup $170? Well, this price here would have to be X plus $1.70. So if X is 30, this would be $31.70, right? Now remember, the value of a call at option expiration is all intrinsic value. Intrinsic value, again, is value in exercise, and it's the maximum of S minus X, or 0, times 100. There's the multiplier again. And in this case, we see that 3170 minus 30 is $1.70, and that's bigger than 0. So $1.70 times 100 is $170. Let me fix that dollar sign. There we go. And so that's showing us the value at option expiration of the long call, of the call, if the stock price is then $31.70, and we see that it's worth $170, then of course our profit will be equal to the value, 170, minus our assumed cost of 170 is 0, and that's the case right there at the break even. And that will be enough for video number 6. Thank you.